Good afternoon, everybody. Welcome once again to the weekly live webinar presented by Affinity Federal Credit Union. My name is Oscar Cordova, and I'm an external affairs specialist here at Affinity. I manage the financial education efforts of the credit union in the areas that we serve. Today's topic is long-term care. Great topic for us to learn, and I know that you guys, whoever has questions, please be engaged and ask a lot of questions because the person who will be presenting for us is an expert in the matter. His name is Patrick. As a consultant of Global Atlantic Financial Group, Pat delivers impactful and inspiring presentations, seminars, and training across the country. With over a decade of experience, he brings a wealth of knowledge to these presentations and continuously keeps abreast of industry trends and best practices within financial services. Earning his CLTC designation, he will be providing insight into long-term care planning today that will help you address your questions and concerns related to this topic. Now, I just want to remind everybody that this presentation is being recorded, so you guys will receive an email after the presentation tonight, thanking you for attending, with a link to rewatch this presentation in case you guys want to review it once again, or you guys missed something, or maybe perhaps you guys want to share it with a family or a friend, okay? As I mentioned before, Patrick is an expert in the matter, so please be engaged, ask questions, that's what we're here for. And at this moment, I would like to turn it over to Patrick. Patrick, thank you so much for joining us today.
Thank you for having me, Oscar. Thank you all for joining in to this session here. This topic of long-term care is very near and dear. My experience in the long-term care industry actually dates pretty far. So professionally, I've been in the long-term care industry for over a decade, keeping up with trends, not just long-term care insurance, mind you. Our theme today is really clearing the air on long-term care. We want to set the stage. So not just what long-term care insurance is, we'll touch on that, but also just what long-term care is in general. Because there's a lot of perceptions out there when it comes to long-term care. Again, I've been in the industry for over a decade, and I've seen this. I've seen things that have been read about in social media or on the news. There may be things that we've heard about from loved ones, family members, or friends just through conversations. My experiences is actually dated a lot further than that. My mother was an RN working in the emergency room when I was born. But as her career progressed, she started providing home health care to individuals in their places of residence. So whether it was their apartment, their house, their condo, wherever they were living, she was going out to their house and giving them care in their actual homes, in their places that they've been living for their entire lives. And so I saw that secondhand. I also saw it firsthand when my grandfather had needed care. So this was my mother's father-in-law, diagnosed with pancreatic cancer, was in a nursing care facility. But because my mother had the training, she had the flexibility in the schedule, and she had the ability, we were actually able to bring him into our home. So we actually had a hospital bed set up in our living room for about a year and a half when I was 7 years old. And my mom cared for him for a year and a half. When you fast forward to when my grandmother had needed care, now this is my mother's mother, mind you, she had needed care. Unfortunately, my mother was towards the tail end of her career. She didn't have the flexibility in her schedule to give her quality care that she did her father-in-law. So unfortunately, my grandmother had needed care for about 5 years in a nursing care facility. And while I've seen this in all aspects of it, I understand that that's not the case for everyone. We all have different perceptions. We all may have read about something or heard about something related to long-term care. So our goal here is really to clear the air on long-term care. We want you to ask questions. There is a Q&A tab here that you can click on, that you can type in questions. So feel free, if you have any questions, open up the Q&A tab, type in your question, and we'll address it at the end of the call. So how do we have this discussion? And I know everyone's situations are different. They may have had a positive experience, a negative experience. Maybe, you've seen some facts and some numbers and statistics, but nothing has ever been kind of laid out. And so our goal today is really not to solve anything, but give you more information so that you can make more informed decisions and work with your financial professional at Affinity Credit Union to help solve this need of long-term care. So where do we start? Well, first of all, these presentations that we're giving today and have been giving for quite some time have pretty much been virtually. So not face-to-face. It has usually been in this type of environment. But I will tell you, when prior to the pandemic, we were having these presentations and talking about long-term care, it was very interactive. And so I would always ask this question to start, is that, when you hear the words long-term care, what really comes to mind? And we took a lot of the feedback that we had. So if you've had an experience with long-term care, what do you think of? What comes to mind? What do you envision? What word association do you have with the words long-term care or those letters LTC? Now, will be more rhetorical today, but what I've seen is that always, long-term care ends up being associated with nursing homes and nursing home care. And so it's important to stress that long-term care is, yes, it's inclusive of nursing homes, but it's so much more than that. We'll get into that a little bit later in the presentation, but I'd like to kind of separate the idea of long-term care equals nursing homes and vice versa, because we're doing ourselves an injustice. Now, what we've seen during the pandemic, during COVID, is obviously there's been a high mortality rate within nursing homes. And so that, even prior to the pandemic, would be the last place anybody would want to be. However, what we've seen now is it's even more exacerbated. More and more individuals are getting care in their homes today than had been prior to the pandemic. But if we only associate nursing homes with long-term care and say, well, you know what, why should I plan for long-term care? Because I never plan on receiving nursing home care. I plan on staying in my home, or I plan on moving to a retirement community that has nurses' aides on hand. So if we think about the idea that we won't need it, again, we're doing ourselves an injustice, because what you're going to find during this presentation is that for those that plan, those that think about the potential of needed long-term care, you keep your options open. And also, long-term care is not necessarily the funnest topic to talk about. It's not like talking about retirement planning or income planning, because that's talking about the day that we retire, we can start getting up later, we can start checking things off on our bucket list, we have more time to spend with family and friends and our hobbies that we may have been putting off during our working years. And so when we think about long-term care, a lot of times it gets associated with medical care. But let's look at some of the facts. Let's look at some of the statistics here, and I'll give you some context to this. Now, statistically speaking, we know that on average, the chance of any one of us needing some form of long-term care is about 70%. There's about 70%, 7 out of 10 people are going to need some form of care. Now, that number can be extremely intimidating, but the good news here and the silver lining is that, again, most people who plan on needing long-term care services won't even end up setting foot in a nursing home. In fact, you're more likely to receive care where you'd prefer, which prior to the pandemic, so prior to COVID, prior to the pandemic, over half of all long-term care services was taking place in that individual's home. This was over half. Now, a couple things. Prior to pandemic, this was also what was being paid for. So this wasn't accounting for individuals being cared for by family members or by friends that were not being compensated. So over half. Another about 25% of long-term care services, again, prior to pandemic, was in community-based care. And what do I mean by that? Well, community-based care is simply either assisted living or retirement community care. So think about these retirement care communities. They're usually a 55 and older community. If you're downsizing, maybe empty nesters, one floor unit. We have one that is about 5 minutes from where I live, where you can move in, and typically you move in independently. You're usually not needing care when you enter, but if you or your spouse ends up needing care, they actually have nurses' aides on hand that can actually come into your unit. So the goal here is really to not uproot you and change things if you end up being one of the individuals that does end up needing care. And most long-term care services, it's not necessarily the medical care itself, but it's things we do each and every day. And so there's a couple reasons that we would need long-term care services. So there's really two different components. There's the physical need, and then there's the cognitive need. So let's go through each. When we talk about the physical need, we're talking about activities of daily living. You may have heard that terminology before or read about it, or ADLs. So what are the activities of daily living? Well, they're right up on the screen here. It's taking a bath or a shower, getting dressed, using the restroom, getting in and out of your bed or in and out of a chair. It's eating. Incontinence is associated with going to the restroom as well. So these are what's considered the 6 activities of daily living. It's 6 things we do each and every day. So for someone that may need help with at least 2 of these activities, maybe more, maybe 3 or 4, or all of them, the person helping you with those are actually helping you with long-term care services. And I look at it this way. My daughter is 2 years old, and so I help her get dressed, and I help get her bathed or showered. And so, it's not necessarily long-term care, but we think about long-term care at the older ages. And so since I'm helping my daughter with those things, I'm actually helping her with long-term care when you kind of think about it from that perspective. But obviously, long-term care for purposes of retirement planning is if we have an ailment, if we have a condition that requires us to need some help. Now, what I'll share with you is that you may have had experiences, whether it was a family member or a friend who had needed long-term care, maybe it was a parent or grandparent. And so what I'll share with you today is that because of medical advances, because of treatments and procedures and surgeries that exist today, your need of long-term care may not be the same reason that your parents or grandparents had needed care. And so let me give you an example that we may be able to relate to. And so when we talk about surgery related to knee replacements, so if you have had a knee replacement in the past, it's progressed actually pretty significantly, the surgeries have. So let me take you back to the 1980s. And if you were to have a knee replacement in the 1980s, it was a pretty involved procedure. Usually it was about a week or so after the procedure that was done before you were even able to get up and out of bed and move around. It was months after the surgery before you could walk unassisted without holding onto the wall or using a wheelchair or a walker or even a cane. And so you think about that 20, 30, 40 years ago. But if we look at long-term care today, so a knee replacement today, typically your surgery is scheduled in the morning, but by the afternoon, you're already up and out of bed. It's usually less than a week before you're walking unassisted, and in just less than a month, you're in a much, much better situation than you were prior to the surgery. And that's because of medical advances. You look at treatments and surgeries and things that are extending individuals' lives. So the need that you may have of long-term care may still be physical, but where we're seeing a greater rise is due to a cognitive need, cognitive impairment. Now, when I use this terminology, cognitive impairment, what am I referring to? We're talking about different forms of senility. Alzheimer's disease is the most common form of cognitive impairment in this country. So when we talk about cognitive impairment, we're talking about loss in memory, in reasoning, in judgment, in awareness. And so what we're seeing is that there's still not the medical advances from a cognitive standpoint that we are from a physical standpoint. And as you can see on the screen, the numbers speak for themselves. We know that less than half of people who actually have Alzheimer's disease know that they have it. Compared to the physical need, we know that over 90% of people with cancer actually know that they have cancer. And so I look at my father. My father is a great example here and really kind of speaks to where we're seeing the long-term care need increase over the next 5, 10, 15, and even 20 years. So my father has actually had 3 bouts of cancer. He's had skin cancer, he's had stomach cancer, and he's had kidney cancer. Now, today he's cured of all 3, fortunately. The skin cancer removal, that was a pretty easy outpatient surgery. But his stomach and kidney procedures was a procedure that actually didn't even exist 5 years prior to when my dad actually had the procedure done. So I look at my father and I say, okay, if my father just happened to be born in the previous generation, maybe not even that long, maybe even just 10, 15 years earlier than when he was born, those procedures may not have existed. He may have not been able to have the cancer removed, and the cancer may have won. He may not be alive today. Instead, my father's life has been extended because of those procedures, but now he falls into the camp of a greater risk of developing a cognitive impairment. And, some of the feedback, some of the pushback that we've gotten related to long-term care and long-term care planning is, well, Pat, why do I really need to plan for long-term care when the average nursing home stay is only about 2.5 years? Well, there's a couple things here. First, as I mentioned, long-term care is more than just nursing home care. So that 2.5 years doesn't take into account home health care prior to that. But also, if we take into account cognitive impairment, so a form of dementia, the need of long-term care in a nursing care facility is practically twice that. And so when we think about the need of long-term care, it can be physical, it can be cognitive, or it can be both. So when we think about that, hopefully that clarifies our need for long-term care when we think about long-term care. But now let's look at some of the places and also some of the expenses, because this is important. We need to know not only what our options are, but also what the cost of each option is. Now, what I'm showing on the screen is average costs, and these numbers are a little bit dated. So I'm doing an injustice by sharing these numbers. So what I'd like to do is do a different share and share a different screen. What I'm sharing with you now is a website that any one of you can go out to. This is called the Cost of Care Survey. So if you were to go to your internet browser and just type in these 3 words, cost of care, and you Google these, type them into your browser, the first hit that you're going to see that's not an ad is going to be this survey. Why were we using this survey? This survey is nationally recognized to be the most accurate, up-to-date survey of any long-term care information in the industry. The numbers that I was showing you earlier were coming from this survey. If you go out to any type, you see the cost of care being quoted, it's usually coming from this survey. If you go out to the government website, longtermcare.gov, and look in long-term care costs, it redirects you to this website. Any type of financial planning software pulls from this site. The reason, again, is it's accurate, it's up to date. As you can see, we have 2020 numbers, but it also helps to identify what the cost of care is for the different locations. As you can see, we can break it down monthly, daily, hourly. If we look at it on an annual expense, a lot of times this $100,000 private one-bedroom nursing home is the number that's being highlighted. But the reality is that the majority of people are not needing nursing home care. It's home care. And so what you can do is identify what the cost of care is in home or possibly in community care. Now, if you want to change the hours of in-home care needed, because this is based on about 7 to 8 hours, so you can actually change because it's all based on an hourly scale. As you can see, here's the hourly pay scale for home care. So roughly about $24 on a national average. So if you need an hour of care, you need somebody coming into your house just 1 hour a day, it's going to be 24 hours a day times 365 days a year. If you need someone coming in 24 hours a day, well, then we got to take our $24 number, multiplied by 24 hours a day, multiplied by 365 days a year. But to save you from doing all that math, you can just click this number and type in, okay, how many hours a week am I going to need? There's 7 hours, which is 1 hour a day, up to 168 hours, which is 24 hours a day. And you can do this calculation. The numbers that they're using here on average is about 7 to 8 hours a day. And so it's good to give you these numbers, but what's even better is more accurate numbers. These are national averages. It doesn't necessarily plan on national averages. So what we can do is identify in the map what the cost of care is right in our backyard. So let's look at now New Jersey. Now here's the cost of care in New Jersey. If we want to look at different municipalities in the Trenton area, if we want to get more southern, if we want to look in the New York metro area, so this is New York and the surrounding area, it'll give us our cost of care. maybe, just maybe, you're not retiring in New Jersey. Maybe you're thinking about retiring down to the Carolinas, and you'd want to see what the cost of care is. You can see the cost of care is much, much less in Carolinas than it is in New Jersey and the New York surrounding area. Maybe it's Florida. Maybe if it's Arizona. So what this will help you do is identify what the cost of care is in the place that you're retiring so that we can focus on the home care number. That's really what's important. If we need nursing home care, we can allot other income coming in. Chances are you have Social Security. You may be lucky enough to have a pension. And if you do need nursing care facility care, you can redirect Social Security and your retirement income to pay for nursing home care in addition to any other expense. But this home care expense, this in the state of Arizona, or if we even look on an annual expense, let's go back to New Jersey here to make it more real. So if we look at the average cost, roughly about $5,000 in the state of New Jersey. So then the question is, well, where's this money going to come from? It can't come from our Social Security or other retirement or maybe our pension, because this is an expense above all else that you have in retirement. What do I mean by that? Well, if you're having somebody come in and caring for you in your home, your food bill doesn't go away. Your utility bill doesn't go away. If you have a rent or mortgage that you're paying, that doesn't go away. So you can't redirect your Social Security check or your retirement income check to pay for long-term care because it's already designated to pay for these basic living expenses that you have in retirement. So then the question is well, where does this money come from? And how do we generate $5,000 a month? So let's go back here, and I'm going to shift back to the presentation, and I'll give you some guidance on what we've heard. And so when we think about the different options that we have, a lot of the feedback we have is, well, you know what, my spouse lives with me, I have children close by, I have family members close by that can care for me. And, you know, it's interesting because when you take into account the unpaid care that's being provided, it's significant. I mentioned over 55% of long-term care services pre-pandemic was home care. But if you take into account the unpaid care, because that number, that 55% was just what's being paid for. If you take into account unpaid care, that number jumps closer to 75%. So 3 out of 4 situations, that individual is getting cared for in their home. Maybe it's being paid for, maybe it's being unpaid for. But understand what that means. If you're expecting your spouse to be the one providing you the care, are you really expecting them to actually be providing care, or are you more or less expecting them to manage and supervise your care? Care providing versus care supervising or care managing is entirely different. Let me give you a perspective. So if let's say it's your spouse and they're the ones that are providing you care, the moment that they wake up, they have to go to work. They have a to-do list. You know, if it's someone who's not living with you, a family member, a friend, maybe it's a child or a neighbor, someone close by, the moment that they show up at your house, they have the chore list. They have that to-do list. You know, maybe it's cooking, cleaning, making sure you have your medications. And that can be a significant toll on an individual and very grueling, especially if it's each and every day. What happens if they get sick? What happens if they're looking to take a vacation or other things that they have to care for? That's providing care. Managing care means that they're still a part of your life. They can still help. They're still there. You know, I remember when my grandmother had needed care, you know, I spent time with her. You know, but there was some situations that I had to help her go to the restroom, you know, and so it was very, the level of relationship between grandmother and grandson just wasn't there when you're helping someone go to the restroom. And so managing the care means that you're having someone coming into the house and helping with those activities that may be a strain, it may be physically hard, it may be mentally hard and challenging, but you can still keep that relationship. You can still be the wife or husband, you can still be the son or daughter or friend, but managing the care, supervising the care, is still making sure that the individuals coming into the house are caring for you the right way, but it goes back to that point that if you're supervising it, how are we paying for it? And when we polled individuals and said, okay, well, what's the plan? We usually landed on one of these 5. So as you can see up on the screen, we have Medicare and Medicaid, government spending, health insurance, self-fund, you can also refer to that as self-insure, or long-term care insurance. Now we're going to go through all these here, and we're going to clarify what each do and don't cover to help you. Now, in order to keep Medicare and Medicaid separate for purposes of long-term care, what I'd like you to do is think about Medicare as health care and Medicaid as financial aid. So Medicare is health care, Medicaid is financial aid. Medicare is really for health care for those that are 65 years of age or older. And so how does Medicare cover long-term care services? Well, the good news is it does, but you need to meet a couple of qualifications first. So the first thing that needs to have happen is you need to be hospitalized, admitted inpatient stay for at least 3 days in a 30-day period of time. So not one night, not 2 nights, 3 nights, admitted inpatient, not outpatient, not in for observation. That's a slight distinction, but it makes a world of difference. Also need to require skilled care. And then third is showing your condition's actually going to improve. And so assuming you meet those three criteria, then yes, Medicare will cover your long-term care services, whether it's home care or nursing home care or anything in between, up to the first 100 days. The first 20 days are covered 100%. There's not a dollar you have to pay. That's going to be covered by Medicare Part A. The next 80, so day 21 through day 100, there's a copay. And as you can see here, so if you have supplemental Medicare insurance or Medicare Part B, that'll cover the copay. But after 100 days, Medicare is no longer going to cover your long-term care need. Now, it's important to note that if after 100 days of receiving care, you go back into the hospital and you're there again for 3 days over a 30-day period of time, checking the boxes, then you can restart it. But bouncing back and forth between needing care in the hospital every 3 months or so is not a way of life. The good news is that with Medicare, it's there as a Band-Aid. But if you're going to need any longer than 3-4 months of care, it's not going to be a viable source to pay for that long-term care need of $3,000, $4,000, $5,000 a month. So we look at the next four. Now, Medicare is health care, and Medicaid is financial aid. So Medicaid is there for those without the financial resources. Medicaid is financial aid for those without financial resources to pay for long-term care on their own. So you have to be below not only an income limit, but also an asset limit. What do I mean by asset? The amount of money you have. And so draw your attention to the bottom left of the screen. You're seeing less than $2,000 in countable assets. All right, so what does that include? Well, it's easier to tell you what's not included. So in countable assets, it doesn't include your home, meaning that your home is excluded from that number. But if you have any rental properties or vacation homes, that goes into countable. It doesn't include a car, but if you own any more than one car, it does. It doesn't include your furniture or jewelry or anything related to your funeral. But pretty much anything else is fair game. And so you have to be below $2,000 in assets in order to just be eligible for Medicaid. That's the first thing. If you're married, the spouse can keep half of the communal assets, but there's a cap. Today, it's roughly about $130,000, meaning that your spouse can keep half of the assets, but that caps out at $130,000. But most importantly, and here's what's not stressed enough about Medicaid and Medicaid planning, because I hear it all the time, Medicaid attorneys, talking about let's open up a trust, let's move assets into the name, and then you can rely on Medicaid to pay for long-term care. Well, here's what they don't tell you, is that you're limited on your choices for care. Typically, home health care is not an option. Community care is not an option. Typically, the only option available is nursing homes. And if you take one thing away from Medicaid and Medicaid planning, it's that 70%. 7 out of 10 people in a nursing home pre-pandemic were supported by Medicaid. 70%. And think about what that means today. That means that over half of people in a nursing home, they don't have $5,000 to their name to pay for someone to come into their home. They don't even have $3,000. They have less than $2,000. And how many of those individuals would have much rather preferred to stay in their home, their place of residence, but they didn't plan? And this is why I stress that most of the time for those individuals that do plan, nursing homes do not factor in to the equation. They may, but for the most part, it's home care, it's community care, it's assisted living, it's residential care communities. So the good news is with Medicaid, it is there for those without the financial resources to pay for it on their own. But if you have any more than $2,000 to your name, it's never going to be the first line of defense. So let's look at the next three. Now, health insurance, if you have any type of health insurance, it's usually similar to Medicare, covers only short-term for medically necessary care. So again, Band-Aid. I'm going to skip over self-fund for a second, and I want to stress long-term care insurance because, when we think about long-term care, a lot of times individuals associate long-term care with long-term care insurance. And long-term care insurance is just a means and a way to pay for that long-term care expense. Now, I mentioned earlier how the needs of long-term care have evolved. I mentioned the fact that surgeries and treatments and drugs and procedures have given individuals a need of long-term care, and it's shifting. So less of the physical need, more of the cognitive need. So there's been an evolution in the need of long-term care. There's also been an evolution in long-term care insurance. And so when I talk about long-term care insurance, a lot of times I'll have people say, well, long-term care insurance, I've heard about people paying tons of money into these policies, and if they're one of the lucky 30% that doesn't need care, then they never see that money again. And I've also heard that for individuals that have had these types of policies for 5, 10, 15 years are now being asked to either pay in more to the policy and keep their coverage the same, or continue to pay what they have been paying, but they're now going to give you less insurance money. And so keep in mind, these types of policies, what we call the traditional long-term care insurance or the premium-based or standalone policies, are not bad policies. What we've seen is just a supply and demand. Back 20 years ago, there was over 100 different insurance companies that you could go to purchase the traditional type of long-term care insurance. The type of insurance similar to your homeowner's insurance or car insurance that you pay that premium maybe once a month or once a year, and if you have a long-term care need or if something happens, you can collect the insurance, but if you don't use the benefit, you don't see any residual benefit to it. And so what we've seen is a lot of individuals still self-funding, or the terminology self-insure has come into place. Only about 5% of individuals have long-term care insurance. Now, for those that may have purchased long-term care insurance and have gotten that letter to say, hey, pay in more, it's not necessarily, financially speaking, the worst thing to continue to pay those increases, and here's why. If you were to try to purchase the same type of insurance today, maybe you purchased traditional insurance 5, 10, or even 15 years ago, you're most likely not going to be able to buy the same policy today with the same bells and whistles. So keep that in mind. But let's talk about self-funding for a second, because that was the old way of long-term care insurance. There has been an evolution in a new alternative, what we call hybrid long-term care. So there's different phrasing for this. There's different acronyms that are used, different terminology. So I'll go through a few that you may have read about. So hybrid long-term care, meaning it does a couple of things. It gives you long-term care coverage, but if you don't use the benefit, you don't lose your investment. There's asset-based long-term care. It's the same thing. Hybrid and asset-based are the same thing because the money is fronted, and I'll get into that in just a second. Linked benefit is another terminology. Or simply put, self-funding alternatives. Now, for years and years, there's been these types of programs that have existed which offer a life insurance that gives long-term care. So it's really a life insurance that will provide you long-term care in the event that you need it prior to passing away. What we have seen evolve is also an annuity that offers long-term care. So let me give you one idea, just because I'm talking about this conceptually speaking, but I want to give you a visual that can help you understand how these concepts work. We're not going to go through every single solution that exists with you today. That's why our ask at the end would be to sit down with your financial professional at Affinity Credit Union to walk through maybe what solution is best for you. But we're going to share one, and one from Global Atlantic, which is called ForCare. Now, this is a hybrid, asset-based, linked benefit, self-funding alternative solution that combines the benefits of a fixed annuity with long-term care. Now, for those that are not familiar with this terminology, fixed annuity, what is a fixed annuity? Just simply put, a fixed annuity is really nothing more than a tax-deferred CD, but it would be issued by an insurance carrier versus by the financial institution. But where this is different is that it offers a long-term care benefit that takes whatever money is in that account, whatever you have in the annuity value, and it's deferred, so again, it's working just like a tax-deferred CD, and will instantly multiply it day one, doubling or tripling that amount for your long-term care expenses based on how you'd be approved health-wise. So simply, if you have $50,000 and you've designated that as your emergency money if you or your spouse gets sick, well, with this type of program, that $50,000 is still your money. It's still there. It's in a fixed account. It's earning some nominal interest. But if you or your spouse ends up getting sick, you have access to not just your $50,000, but because it's multiplied by either 2 or 3 times based on your health, that $50,000 is actually worth either $100,000 or $150,000 for your long-term care expenses. Now, if you're not married, if you're single, it still works the same way, either $100,000 or $150,000 for your long-term care expenses. Now, I mentioned the fact that these types of programs can cover both lives. You can cover just yourself, or if you're married, you can cover your spouse as well. But because it is long-term care, any money that you take out of the account to use to pay for long-term care expenses are tax-free. So there's no tax ramifications on the fact that the money is being multiplied. Now, some of you may be thinking, listen, I've had some experience with insurance. Maybe it was life insurance, long-term care, and I know it's cumbersome. Isn't there a medical evaluation? And the truth is, there is. With any type of insurance, there's always a medical qualification verification. The terminology they use in the industry is called underwriting. However, these types of programs are simple, convenient, and straightforward. So rather than taking a week or a month or having a nurse come out to the house and taking blood and urine samples, sitting on the phone for an hour going through all medical history, this is a quick and easy 30-minute process where we see over 90% of people who actually apply for these types of programs get approved. Now, you may be thinking, well, you know what, I've had experiences before. I've heard that it's very tough at my age. The average age that we see for these types of programs are about 70 years old. So if you're thinking, listen, I'm 80 years old today, I was thinking about I should have purchased long-term care insurance when I was younger. Well, the good news for you today is that these are still available up through and including age 80. And it's a very simple process. Again, no nurse coming out to the house and taking an evaluation. You're not sitting on the phone for an hour or two playing games. It's a quick 30-minute process going through a couple pages of medical questions just to make sure that you're not needing care today. We know, again, over 90% of people are approved, but at the end of the day, the reason that these types of programs are becoming so popular versus the old way, versus the traditional way, is that if you don't use the money, you don't lose your investment. Any value that you invested into these types of programs, plus the interest, will pass to your beneficiaries if you were to pass away prior to needing long-term care services. So it's different. These types of concepts are different than the old way. And let me give you some other numbers that you may be able to relate to. So when we think about long-term care and kind of what's trending, what I'm sharing with on the screen is these numbers are a few years old, but the trend has continued. What we've seen is the amount of dollars going into the standalone long-term care insurance. These are the use it or lose it type policies. These are the policies that we've seen the premium increases. And so as you can see, it's decreased, and that's just due to availability. But what we've seen gone the other way is these annuities with long-term care. Just last year alone, over $500 million into these types of programs. This is the new way of self-funding. Because instead of just self-funding, for every dollar worth of dollar of care, you would pay 50 cents for every dollar of care, or 33 cents for every dollar of care. Now, I'm not going to go too much into detail on the actual qualifications because we can get really far into the weeds. I know we all have different health situations, but how simple is it? How simple is this program? Well, this is the approval questions. These are the qualifying questions. These are the questions where if you can pass these first 5 questions, there's a very good likelihood that you're going to be able to at least double the amount of money that you'd have for care. And again, I'm not going to go through all of these, but question 1 says, are you hospitalized, confined to a bed, or living in an assisted living facility? Question 3 says, are you in a nursing home today, receiving home health care today, or using some type of medical device that basically requires you to need long-term care? Question 4 says, do you need help with your activities of daily living? Meaning 3 out of 5 of these are saying, do you need long-term care right now? If you have cancer, heart issues, disability, rheumatoid arthritis, osteoporosis, that's not going to cause you to be denied coverage. So if you can answer no to the first 5 questions, there's a very good likelihood that we'll be able to double the amount of money that you'd have for care. We have an additional set of questions where if you can answer no to would show that you could receive triple the amount for care. And again, I'm not going to get too far into the details here. Again, everybody's situations are different. If you want a copy of these questions just to peruse it, make sure that you contact your financial professional at Affinity Credit Union. But let me give you an idea here, and it's really just the idea of self-funding, because self-funding is important when we think about the concept of this, because about over 90% of people are self-funding their long-term care expenses. It's actually closer to 95%. So if you are like many, you may have investments in different accounts. You may have some investments and deposits at the credit union. You may have some money with wealth management. You may have other financial relationships where you have assets held. And so if you're like this individual, you may have money in CDs or savings. You may own some annuities and stocks and bonds and mutual funds and IRAs, maybe 401k, money in real estate, life insurance. And so then the question becomes, going back to our question, all right, if we want to keep our options open, and if you prefer home care or community care, how are we going to afford that $3,000, $4,000, $5,000, maybe even $6,000 a month? Where's that money going to come from? Now, typically speaking, what we've said is, well, we know that CDs and savings are liquid and accessible. We know that it's not going to be negative. Same thing with fixed annuities. So for this individual who has almost about $2 million, they could probably self-fund. But when we asked them the question, where is this money going to come from? They said, well, it was coming from my CDs and savings and fixed annuities. I wasn't going to sell my life insurance. I'm not going to sell my real estate, my IRAs, 401ks. That's for my retirement income planning, so I don't want to sell that off. So here, this individual has $150,000 set aside for long-term care expenses, which is pretty significant. That's a pretty significant sum of money that's designated. Where these types of concepts work very well is that instead of having held here, if we shift it to one of these hybrid asset-based solutions, you still have $150,000. That's still your money. It doesn't go away. You have annual statement. You have access to it. It goes to your beneficiaries if you don't use it. But if you do need long-term care, if you're one of the 70% of individuals who need care, or one of the 90% of couples that need care, depending on how you'd be approved, you'd have either $300,000 or $450,000 for long-term care expenses. So think about it this way. If this individual has $150,000 set aside, that will cover less than 3 years. What happens if they need longer than 3 years worth of care? Where's the money going to come from next? Well, this is a self-funding alternative. And if you're thinking, well, you know what? I'm just going to wait because interest rates are low now. I know that they're going to come up eventually. Let's look at it conceptually speaking. If we know that we can triple the money today for our care, what if we were just going to try to earn interest on it and say on $150,000, grow it to $450,000? Let's say a 3% interest rate. Well, it'll get there. It's just going to take you close to 4 decades. It's going to take you over 2 decades just to double it. But I would assume that the majority of the liquid or accessible money is not earning 3%. It may, but if it's earning 1%, how long is it going to take for that money to triple? Well, it's going to take about 1.5 years or just north of about 70 years in order to double. And so the concepts that we shared today, we didn't want to solve anything today. What we wanted to do, though, is give you those ideas, those thoughts. You know, when we think about what we accomplished today, we talked about some of the perceptions to long-term care, you know, what we're thinking about. You know, we have to get away from the idea that long-term care is nursing home care and vice versa. You know, the fact that the reality is that the majority of us are going to need care, and if we think about it from a planning perspective, we're going to be in a much better situation. Using that website that we shared, the cost of care, just Google the words cost of care, and you can look at the numbers for yourself. Come the beginning of next year, they'll be updated for 2021. You know, we went through the example, and we really shared what was trending. And so our ask here is, again, not to solve anything, but to make and have that next conversation with your financial professional. Don't wait until next year or the year after, because we may have lost some of the knowledge that we've gained from this session here today. So with that, those are my prepared comments, but I know I've been watching the Q&A and the chat feature. So Oscar, what I'll do now is I'll turn the call back over to you, and maybe we can address some of the questions that have already come through. And if any of you have any questions that you've thought of, feel free to, again, open up the Q&A feature and just type them into the question and answer box, and we will address those questions here for you today. So Oscar, I'll turn the call back over to you.
Thank you, Patrick. Thank you so much for this great presentation. Yes, there's a couple of questions this afternoon. I'll start with the first one. If I fork out premiums to one entity and later find a better plan with another carrier, are my premiums portable?
So that's going to depend on the type of insurance protection that you have. So typically speaking, if it's a traditional premium-based policy, standalone policy, it is not. If it's a hybrid program, it can be. What my suggestion would be to the person that answered that question is share that information with your financial professional here at Affinity. And what they can do is we can be a consultant there and actually look at it, because there's hundreds. I mentioned there's over 100 companies that were offering traditional insurance, hybrid, same. So there are a lot of different versions. We would just need to look at the policy. So I would ask you to answer that question for you. It depends, but to answer it, if you have your statement, if you have information on that, share that with your financial professional. We can get an answer for you on that particular program.
Thank you, Pat. Next question. Can you speak to long-term care plans that pay you back if you never use them?
Yep. Yeah. And so that's really, again, our theme that we wanted to talk about, which is hybrid long-term care, asset-based long-term care, linked benefit long-term care. Again, all those names are synonymous. Most of the different programs that exist or have existed for some time are life insurance with long-term care, but the one we talked about today was an annuity-based long-term care plan. So these are the type of programs that if you don't use the money, you don't lose it. And when we look at 2019, so we had the 2019 numbers that we were looking at just recently, over 85% of all long-term care policies that were sold from 2015 to 2019 were these hybrid long-term care, these self-funding. So in the end, if the insured didn't use the money, they didn't lose their initial investment and had some residual value that they could either access or pay to their beneficiaries if they were to pass away.
Excellent, very good. Next question. For the annuity-based plans, is your health reevaluated periodically with the possibility of reducing benefit? No.
And most hybrid programs don't require a re-up or reevaluation. The one that we shared with today, absolutely not. And most policies don't. There may be some out there that I'm not aware of that I haven't reviewed, but the majority of these types of programs, the majority of these types of hybrid is that you go through the underwriting, the health qualification today, and then as long as you have the plan in place, they're not going to require you to be reevaluated. So once it's locked in, it's locked in. You know you have coverage. You know that you don't have to worry about down the road having to be reevaluated. Because typically speaking, we know, if you're in good health today, chances are, 10, 15, 20 years down the road, your health may not be as good as it was when, 20 years ago. I look at my health today. I'm obviously not as healthy as I was 10 years ago, but that's just the nature of aging. And so there is no requirement to be reevaluated once the plan is in place.
Next question. If I were to get insurance, will it cover me if I lived in a different country?
So there's different programs that do allow certain coverage outside of the state. The one that we shared with today does not cover international care. And you have to look at the different policies that exist, because when you have certain policies that offer international care, there's a couple things that go into play. It's the actual designation of what is and what isn't long-term care services and long-term care facilities, and each country is different. And then also the taxation, because with long-term care policies and long-term care like the one I shared today, all the money that you'd receive is income tax-free. If you go international, now that causes additional scrutiny or requirements. So to answer your question, the one we shared today does not, but that doesn't mean that others don't, and there may not be other versions. So again, it makes sense to have that conversation with your financial professional to review international care if that's your expectation, that you plan on retiring outside of the United States.
Fantastic. Very good. Next question. What if the insurance company goes under?
So that's a great question. And there's a lot of levels of protection here. And so, I'll go through a few just so that you're aware of them. So when it comes to insurance, and this is actually a long-term care mandate, so it is required by the National Association of Insurance Commissioners that there is 60 cents for every dollar guaranteed of a long-term care policy to be held in reserves, meaning that, if you take a Global Atlantic as an example, for every dollar that they insure, they have to keep 60 cents in reserves ready to go out. So fully liquid, can't be invested. So that's a certain level of protection. That's if every single person goes on claim at the same day, needs the maximum amount of care, you have to keep 60 cents for every reserve. And that's a national mandate. So that's Global Atlantic, that's Genworth, that's Hancock, that's all companies. So that's the first level. The second is that you look at insurance companies and ratings just like you would have in grade school. So obviously you have A-rated companies are the best, B-rated, and then obviously we don't deal with C's and so forth. And so you have to look at the rating agencies and their claims paying ability. So that's the second thing. The third is that a lot of insurance companies are reinsured by other insurance companies. What does that mean? Well, if you're doing business with a certain insurance company, what actually ends up happening is they actually work with another insurance company to reinsure, meaning that if the company goes under, the reinsurance of another insurance carrier can actually kick in to actually help cover that expense. And then finally, different states have different state guarantee associations. I won't get into the details here, but basically in order for an insurance company to do business in any state in the United States, they have to pay into the state guarantee association of that particular state. And what happens is if the company goes belly up and if all the reserves are spent and there is no reinsurance company that kind of comes to board, then the state guarantee association can actually come in and cover the insurance costs up to set limits. Again, states are different based on their caps, based on the type of programs, but there's a lot of levels of protection when you think about an insurance company going under.
All right, very good. Next question. What is your phone number for follow-up? So I'll answer this one. In the follow-up email that I will send over, I will include Pat's information, email and phone number, so that you guys can reach directly to him in the event that you guys want to explore or have questions that you guys may feel that you guys want to ask on a more one-on-one basis kind of thing, okay? And then the last question of the afternoon that I see here, are annuity funds subject to market fluctuations?
That's a great question. And so when we think about deferred annuities, because annuities can take all different forms. And so deferred annuities are annuities we're not taking money from. You can, so like if you win the lottery, you can take annuity payments or you can take that lump sum. That's not what we're referring to here. We're talking about deferred annuities. And so there's a couple different variations to them. You can have variable annuities, which are invested in different investments, and that can fluctuate. However, with these annuities, they are fixed, meaning that it is a fixed rate. Right now, the fixed rate is about 2.5%. So that is a fixed rate. So there is no fluctuation in that rate. So that's why I referred to fixed annuities as really a tax-deferred CD. A variable annuity, that works a lot more like your 401k or maybe some of your other investments that you have in the stock market that can move up and down. But these particular ones, we're talking about really conservative fixed investments, meaning that you're going to get a fixed rate of return on the underlying investment. And the good news is that if you do end up needing care, you have that multiple that's going to pay out for your long-term care services.
Great, excellent. So it looks like there's no more questions this afternoon, Patrick. So at this point, I would like to bring this webinar to a close. I would like to thank everybody for staying behind, for paying attention, for being engaged. There were a lot of great questions this afternoon, so thank you, everyone. I look forward to seeing all of you next week on the next installment of the Affinity weekly webinar. And at this point, I want to turn it over to Patrick for any parting words.
Thank you, Oscar, and just thank you all for dialing in. As I mentioned, this is a very near and dear topic to me. I've seen it. I've witnessed a lot of experiences, both professionally and personally. So, my last ask is that we had a lot of questions that we just weren't able to give you concrete information. So my ask is have that ongoing conversation with your financial professional. Pursue your conversation. Maybe you don't have to make a decision today, but at least understand maybe some of the answers to your questions. We all have different situations, but we don't want to wait until next year or the year after. When we think about our health changing, you may be in great health today, but the challenge is especially when it comes to insurance, if your health changes, it may close some of the options for you. So please don't wait. Please start that conversation. If you haven't had it already, please start it here soon. So thank you all so much. Thank you, Oscar, and have a great rest of the week.
Thank you, everyone, once again. And please look out for my email that I'll be sending later today. Thank you, everyone, and you guys have a great afternoon. Bye-bye.